Head over though and get a bit of an idea of how we're expecting to start the session here at home in just over an hour, about an hour and a quarter's time. James Gerrish of Shaw and Partners joins us now. James, pleasure to have you on the program. Thanks for joining us. I think futures were pointing quite a bit stronger earlier this morning, or really early this morning. Have since somewhat flattened, I guess, maybe a mild gain for the market. What are you expecting?
Yeah, mild gain to the market this morning. Ingrid, all eyes will be on NAB coming out of their trading halt. Banks were obviously a key focus in the market yesterday. It was actually a really encouraging day yesterday, given you had the big influential banking sector down on the day. Resources were also pretty flat. So the rest of the industrials, technology, etc., had a really strong session. The market closed up 80 points yesterday. So probably some consolidation of yesterday's gains expected today, Ingrid.
Pretty good effort for the market yesterday, given banks were certainly weakening off. What did you take out of that, James, given NAB prematurely came out with its results in that mammoth $3.5 billion raising?
Yeah, it's probably a good move from NAB, getting ahead of the others in terms of bank capital raising. You know, the result was obviously weak from a headline perspective, but if you dug a little deeper, it was pretty much in line with expectations. They've taken a big charge in terms of their bad debt provisioning going forward. And they've taken a more conservative stance. Ross McEwen's taken a more conservative stance around Tier 1 capital. After this raise, it'll be at 11.2%. They were 10.4 after the additional provisioning they took yesterday. So if you think how that compares to, say, Westpac are at 10.5 Tier 1 capital. So they're either going to, not be able to pay a dividend or need to raise capital when they come up to report shortly. So, the pressure's on the other banks now, other than CBA. CBA doesn't need to raise capital.
Right. Okay. So do you think this will be the biggest one, though? I mean, $3.5 billion. I think NAB held the record already for one of the biggest raisings in Australia, since sort of equalled that with the one yesterday. Do you think the other banks will need to raise nearly as much?
No. So, I mean, NAB is under new leadership. They've taken the more conservative stance. They've sort of cleared the decks. They've, taken things like written down software. They've taken, a bigger bad debt charge, which is understandable given that they're more exposed to business banking, and it's understandable they've got a new CEO who's sort of taking a harsher approach to it. So I think that will be the biggest one, but that'll put them in a pretty strong position in terms of their capital base. They're also, April business lending has been really strong for them. So if you think about, businesses drawing down existing lines of credit, that obviously happened in April, and that's forecast to happen for the remainder of the year. So they're going to experience business loan growth, 13 to 16% business loan growth is what's being factored in. So that's a reasonably more positive backdrop for NAB revenue going forward.
What about in terms of dividends? Because obviously NAB's slashing its dividend by 64% down to 30 cents. I think Rudy Philip Van Dijk was saying that this dividend hasn't been this low since 1993. That's a huge move. We know it was coming, or at least close to that, given what APRA had sort of written to the banks and requested. What do you think the other banks are going to do in terms of dividends? Does this set the scene?
Well, either Westpac won't be able to pay a dividend, or they'll need to raise capital to pay it, given their capital level. So they've either got to go, drop below in terms of their capital. And we all know that, NAB has been the weakest capitalised bank for some time. It underperforms as a consequence of that. We're in an environment where money flows to sort of the highest quality in the sector, and that's been CBA. CBA is a really well capitalised bank. And they always have been, and that's traditionally been the case. So, Westpac, I think, is at risk of raising capital. Just going back to the NAB dividend, I mean, I know that the term unprecedented is used a lot, but it's pretty accurate in this environment. So 30 cents per share, you're raising capital on one hand, and then you're paying a dividend on the other. It's sort of counterintuitive.
Exactly.
But I think NAB's understood they've understood their shareholder base. So, their shareholder base have got a large amount of retail shareholders in there, so it makes sense to, appease those retail shareholders in the short term. I think they've done the right thing.
What? So rob Peter to pay Paul, in a sense.
That's exactly what they're doing, Ingrid. But in this instance, you've got to have some understanding of your shareholder base, understanding of what your shareholders are looking for. They're the owners of your business, so the easier thing would have been to raise less capital, strip their dividend, etc. But I don't think that would be I don't think that would have been received as well by the market. The fact that dividends low for this point, for this half, it's about what the earnings of the bank look like going forward. So no doubt we're in for a difficult economic time. But if you think about NAB's economic forecast that they put out yesterday, they're calling an 85% probability of a V-shaped recovery. So, I was on the conference call yesterday. There was some criticism of that assessment. But they've done a lot of work in terms of their modelling, as all the banks do, and that's their best guess at this stage.
Do you think, what are you telling your clients? Do you think dividends will return back to a normal level for the banks, I guess, soon? I mean, how long, what sort of lag? I mean, you can't obviously forecast exactly, but what sort of lag are you suggesting, do you think, until banks start to resume dividends or normal dividends?
Yeah, I think it'll be a couple of years out. So NAB's base case from a economic forecast perspective was that in FY20 you're going to see house prices fall 10%. You're going to see unemployment rise to above 11%, and you're going to see a big bad debt cycle from here. But that bounces back in FY21. So FY21 at the earliest. Would be a resumption of normal dividends. But the fact they've raised capital to shore up their balance sheet, that implies that dividends will return quicker than it otherwise would. So if you don't raise capital, and Westpac may not raise capital, they don't. APRA have said that they can withstand lower tier one for a period of time. They may not raise capital, but if that's the case, it'll take them longer to go back to resume normal dividend payments going forward.
All right, James Gerrish, we really appreciate your time. Thanks for joining us.
Thanks, Ingrid.